Hello and welcome to Phillip CFD Web Education Series. My name is Yuan Chao, and today we'll be going through a very important topic which involves you as a trader and an investor. The topic that we'll be going through today is charges and fees. Do take note that all information that is being discussed here today is meant for educational purposes only and does not constitute towards an advice. Without further ado, let us proceed ahead.
First, let us cover on the main topics that we'll go through today. Firstly, we'll touch on the main points of both CFD and CFD DMA charges. Next, we'll go through the final details of world indices, fees and charges. Next, I'll be explaining the rollover concept of CFDs. This will be followed by the margin call concept. Lastly, we'll be going through some worked examples just so that you could understand some of the differences between CFDs and other Phillip Securities Private Limited account types. Let us begin with the first part of our lesson. CFD and CFD DMA charges. As mentioned in our previous lessons, CFD and CFD DMA are pretty much similar except for the mode in which the trades are executed. CFD goes through Phillip Securities Private Limited and CFD DMA goes through directly to the exchange. When a contract is calculated, here is how your profit or losses are realized. First, we would have the gross profit, which consists of the difference between the closing price and the opening price multiplied by the quantity. Administrative charges would have to be subtracted from this total to obtain the net profit or loss. These administrative charges would include the opening commission, closing commission, and the related finance charges. The final equation will look something like this. This is how your profit and losses are realized. Let us go through a quick simple example. Let's say Adam entered a position on an equity at $2.30, purchasing a total of 20 lots. He exited 20 days later at $2.50. Let's realize his profit. First, we calculate the gross profit, which is the difference between the closing price and the opening price. This will then be multiplied with the quantity bought, which was 20 lots. This would give us a gross of $4,000. Now for his net profit, we would require to subtract his commission and related finance charges. Opening commission would be $98.44. Closing commission would be $107. Finance charges would be $138.63. Net profit would be $3,655.93. World indices are charged slightly differently compared to equities. Profits and losses are based on the index point and the bid and ask prices are based on the spread. It is also important to note that the finance charges for world indices are calculated on a daily basis and it is based on the closing price of the index for the day. Also, all contracts will be settled in the respective traded currencies. Here is how profits and losses are realized. The gross profit or loss, which is calculated by getting the difference between the closing and opening prices multiplied by the value of one index point and its quantity. Finance charges would then be subtracted off this value to obtain the net profit or loss. Finance charges are calculated every day as mentioned earlier, and depending on the duration of the counter that is being held, it would vary accordingly. The finance charges are calculated as such. The final equation will look something like this. Let us go through a simple example and explore how profit and losses are realized. Adam buys on STI index and purchases one lot of STI CFD at the price of 2,400 points. He then exits 3 days later at 2,440 points. The value of one index point is $5. His gross profit would be $200. Let us assume that the long finance charge is at 1% and the commission per quantity is $10. opening commission would be $10.70. Closing commission would be $10.70. His finance charges for day 1 would be 32 cents. His finance charges for day 2 would be 33 cents. Net profit would be $177.95. We'll be going through further examples in this presentation, and now we'll move forward to the rollover process. Auto rollover. Now that you have understood the charges and fees, I will now be explaining the automatic rollover process of a contract. Each contract that is made, either long or short, generally has an expiry date of 30 calendar days from the entry point of that contract. There's an auto renewal process, and let me illustrate how it works. Ben went long on a contract at $2. He then holds the contract beyond 30 calendar days. Hence, the automatic rollover would be executed in this case. At day 30, the rollover occurs at price of $1.80. Ben then closed off his position 11 days later at $2.30. How are the fees calculated then? Well, let me demonstrate. Firstly, when Ben enters his position, the opening commission would be effected on his position. On the 30th day, where the contract will eventually end, his profits and losses are realized. How is this realized? Basically, his position will be closed, hence calculation of his gross profit or losses would occur by taking the difference between his opening and closing prices. Finance charges are also incurred, but the closing commission is not. Ben's position is re-entered based on the closing price of the 30th day, in other words, at $1.80. This would then be his renewal process. Once again, when Ben closes his position 11 days later, his final fees are then charged inclusive of the closing commission fees. His net profit or losses is then calculated based on the new entry price of $1.80. It is important to note that when the contract was renewed on the 30th day, there was a loss calculated, and this loss would be debited from Ben's account as well. It is rather important to have some credit in your account in the event should such a scenario occurs. Otherwise, it will incur a margin call. What's margin call, you might ask? Well, this brings us to the next and final topic of this lesson, which is margin call. Before we begin with margin call, let us understand 3 very important terms. The first is equity balance. What does this mean? This is basically taking your ledger balance and subtracting any unrealized finance charges and adding any unrealized profits or losses. Next term to note is called maintenance margin. This is basically between 10% to 30% of the portfolio market value, which is essentially a percentage of your equity balance. The margin excess or deficit is the next term that you have to understand. It is basically the difference between the equity balance and the maintenance margin. Well then, what is actually a margin call? Margin call is basically a warning or a safety net. It is used to inform you that you have reached or surpassed a certain limit in your account. Phillip CFD has 2 different types of margin calls. The first margin call is called the 2-day margin call. This occurs when your equity drops below 10% of your portfolio market value. When this happens, you will be required to either close out some CFD positions to increase the portfolio market value, or to do a cash top-up, either by coming in person to make the payment or transfer it electronically via EPS. The second margin call is called the 1-day margin call. This occurs when your equity drops below 5% of your portfolio market value. When this happens, you will be required to top up your accounts by 3 p.m. on the same day, or all your positions may be forced to close. Do note that you may receive either a day 1 call or a day 2 call, as it is based on the value of your portfolio. Margin call calculations are conducted every 6 a.m. on the same day. Well then, let us do a couple of examples of what we have learned so far and conduct a comparison between the various products. Let's revisit Adam and compare the different charges that he has to pay should he use other products to conduct his trades. Just to refresh your memory, this was what occurred earlier. Adam bought an equity contract at $2.30, purchasing a total of 20 lots. He exited 20 days later at $2.50. We have already observed how this is worked out in the CFD account. Let us see how this is calculated as a DMA trade. Lastly, let's compare this to a stocks account. We can clearly see that the return of investments for a stock account is lower when compared to both CFD and CFD DMA accounts, although the net profit is similar. Let us explore going short. Let us reverse the earlier scenario and have Adam go short on the same counter after he exited. Hence, the entry price would be at $2.50. Adam closes his position 10 days later at a price of $2.20. Let's calculate his net profit. Once again, we can clearly see that the returns of investments is significantly larger when compared to a stocks borrowing and lending account. There's definitely a much larger gain through CFD or CFD DMA. Now, although the gains are big, it is also important to note that the losses can be significantly increased as well. Suppose in the earlier example, instead of earning a profit, Adam makes a loss. After entering a buy position at the entry price of $2.30, the price drops to $2 20 days later. Let us go through and calculate his net loss. Once again, we can clearly view that losses incurred is greatly magnified as well. Hence, do note that CFD is a high-risk product where potential gains or losses can be significantly magnified. Let us do a quick recap of what we have learned so far. We have gone through the different charges between CFD and CFD DMA. It is important to note the difference as this would affect your decision in placing your trades. Next, we have gone through world indices and how their charges are calculated. Note the differences in calculating your net profits or losses. It is also important to note that the positions entered, there is a spread involved unlike CFD and CFD DMA. We have also gone through margin calls and the various requirements that needs to be fulfilled when a margin call is made. Last but not least, we have gone through some examples which distinguishes between the different products to give you a clearer view on CFD as a product. I hope you have learned a thing or two on charges and fees. Till next time, happy trading!